All right, welcome everybody. We are so excited to be here this afternoon with you. We are going to kick off and get started. I'm sure there'll be some additional people that join as we go. But before we do get started, there's a couple things I wanted to mention. First of all, I do want to acknowledge our marketing specialist, Giovanna Sanchez, for all the work and time she puts into creating the invites and links and the materials that we'll be walking through today, as well as our operations manager, Joseph Kahn, who is managing the technology to make this event happen. So special thank you to them. I also wanted on the next slide to just indicate that this presentation is being recorded. So if you object to that, please disconnect now. We will be able to send out a replay of this webinar afterwards. Additionally, there is an ability for you to submit questions. So if you have questions, please feel free to use the Q&A button up at the top, and we'll do our best to respond to your questions throughout, as well as open up time near the end of the presentation to address any follow-up questions. As the disclaimer on this page indicates, we are not giving tax or legal advice. Please refer to your tax or legal professional. This presentation is meant to be educational in nature. We are going to be talking about a number of very exciting things. On the next slide is our agenda. And we're going to be recapping what happened in the first half of the year. Quite a first half of the year, to be sure. So we'll talk about what happened. We're going to talk about Peter Eichelberg, our Chief Portfolio Manager, is then going to discuss what we're seeing moving forward into the latter half of the year. Debbie Baldini, who focuses a lot on technical analysis, is going to discuss some of the opportunities that may exist and potential areas of risks that we need to avoid. So she'll talk a little bit about some of the key indicators that she's following. We also have a couple of unique strategies that we'll be talking about. So ESG stands for environmental, social, and governance screens that can relate to an overlay on the investment analysis that we do. Brandon Perlow, a certified financial planner on our team, takes a very deep dive into this area, and so he'll be talking about some of the opportunities that exist there. And given market valuations and where they are, we're getting a lot of questions about how can we mitigate risk. Matthew Cherry is another certified financial planner on our team, and he's going to be talking about alternative investment strategies in general and a unique strategy to our firm that he's been very key in helping us develop and answer. So with that, let me jump into what we saw in the first half of the year. If I had told you that we were going to see higher import tariffs, rising global tension, potential shrinking economy, continued fighting in Russia and Ukraine, escalations in the Middle East, you would have said there's no way that the market is going to be positive in that type of environment. But the reality is that that's exactly what happened. We ended the first half of the year up slightly more, the S&P 500 up over more than 6% in the first half of the year, which is quite remarkable. If you go to the next slide, what we've tried to do is illustrate all of the items that happened during the first half of the year that had an influence in the market's direction during the first half of the year. We had wildfires. We had threats to the U.S. dominance in artificial intelligence with DeepSeek. We had tariffs imposed. We had tariffs postponed. We had inflation come down. We had unemployment rise. We had Pope Francis pass away. We had Pope Leo chosen. We had U.S. strikes nuclear facilities in Iran. We had any number of events that were all newsworthy, and our job is to go deeper than the headlines, try to decipher between the news and the noise, and really help drive investment performance from there. So if we break down what happened in the first half of the year a little bit further, which we'll see on the next slide, there's a few key statistics that I wanted to share. So first of all, out of the 122 days during the first half, 40% of them were negative. The good news is that 60% of them were positive, including 9 new all-time highs for the S&P 500. The worst day during the first half was a decline just after Liberation Day on April 4th. The market fell almost 6% singly in that day. Only half a week later, the market rose more than 9.5% on April 9th. Huge swings just in that time period there, and that translates to something that's called the VIX. It's an index that measures. It's almost an indicator of investor fear, and it hit the highest level that it had hit since COVID or the Great Recession, things along those lines. So this was a very, very volatile time for the markets. When we look a little bit deeper, though, into the first half of the year, we would say that the first half was really a tale of 3 markets. And you can see here on the right hand of that screen, the first 32 days, the market was up 4.6%. The next 34 days, it fell almost 19%, and the last 56 days, the market was up almost 25%. If we look a little bit further into the next slide, we can see what those 3 tails were really characterized by. And the first 32 days were really driven by what we're going to call Trumponomics euphoria. The market was up 4.6%, and that was really characterized by an anticipation of a deregulation administration, tax cuts, pro-business, hopefully a broadening out of market performance from just the few 7 companies that were driving the market in the prior year. That led to quite a bit of recession paranoia starting around February 20th, where the market started its swoon. And largely that was driven by fears of very high tariffs with our trade partners around the world. That in and of itself led to fears of dramatically slowing growth and dramatically rising inflation. That is the definition of stagflation. And the markets were very nervous about that type of environment. We also saw a lot of uncertainty as, game on, game off, change in direction, and the markets frankly don't like uncertainty, and we saw a lot of that in the next 34 days. After April 9th, we saw a little bit of resolution. This is where we started hearing the phrase, the taco trade, Trump always chickens out. And this was really characterized now by moving through the headwinds and looking past the noise of the day. And we saw some de-escalation of our trade wars. We saw easing concerns around recession and stagflation. Simply the data had not revealed that the economy was slowing or inflation rising. That led to really now quite a bit of momentum behind the market, and you're seeing a bit of FOMO, fear of missing out, where we're now keenly back into the AI-related technology companies. The market, while it was more broad-based, we're seeing a little bit more narrow performance around the market, and that's where we are today. So the market continues this sort of upward momentum trend. So with that, I think that sets the stage a little bit now for me to turn it over to Peter Eichelberg, who is our senior portfolio manager, and he chairs our investment committee. He helps drive the investment allocations and strategies that we see to help implement for our clients. So with that, I'm going to turn it over to Peter. Peter?
Okay, thanks, Adam. So hi, everybody. Adam's already done a great job of recapping the first part of the year and last quarter. And I'm going to refer back maybe to some of that. I did want to point out something we did not get in that chart with all those events, and that was a Fed rate cut. We didn't get any cuts. We don't think we'll get any this month either, but there's some betting markets out there that give the probability to a cut in September. I did also want to mention that I don't have an outlook item on here for the municipal bond market, but I did want to point out that the bond markets have been kind of binary, that the taxable bonds have returned 3-4+% for the year, and the municipal bond markets have lagged. We are looking deeply into that right now, but some of the reasons for that had to do with prices being high at the beginning of the year and the fear that this tax bill that we now have as law could have derailed the tax exemption of those bonds. But since that didn't happen, a lot of the providers we're talking to say that municipal bonds are poised for a much better second half, even if it's just to get back where we were. So I want to put that in there because I didn't have a chance to put that on the slide. So this, what you're seeing here, is kind of a peek behind the curtain of what the investment committee does. We hash it out, we follow a lot of different sources, we do our own internal research, and then we come up with some shorter statements of where we think the market is and where it might be going in terms of positive risks, sometimes granular down to the type of asset, but for the purposes of the slide, sticking with positives and risks. And I want to point out that as we talk about this, we still believe that for our clients, most of the time, it's important to allocate across a lot of different potential risk return assets and make sure that your risk level is appropriate for your financial plan, your comfort level. And as that comes up during the financial planning process, not every portfolio that we run has everything in it that we might talk about here. So if you've got questions after the call, please let the advisor know. Okay, so delving into the current outlook, the bullet points on the screen are what we see in markets at the moment. It's always fluid, but in the positives, despite all the hand wringing that we had during the last 6 months or so, stocks are up nicely, and we have seen relief from the tariffs after they get imposed and then relief again. Worst case tariff scenarios have been downplayed. And we've seen people come to the negotiating table, meaning other nations. So that's been a positive. It's taking some of the pressure off, as well as it's happened enough times now that investors really aren't taking the first headline as the truth anymore, we think. Some corporations have had pretty decent earnings up until recently. And I say up until recently because we have had a couple of reports that weren't as strong. In particular, NXPI is a semiconductor company, and their earnings were not as strong as the market was expecting. Is that a bellwether, or sorry, is that a canary in the coal mine for earnings in tech companies going down or not? We don't know, but it's just something to keep an eye on. We haven't yet seen the tariffs really hit the bottom line of earnings like they're expected to, but the longer they stay in place, the more likely that will happen. Geopolitical tensions have simmered down. That's helped keep the investor confidence high. As Adam mentioned, the Magnificent Seven tech stocks are no longer the only ones driving the gains, although some of them are still doing quite well. Just a quick aside, Apple's down for like the last 1 year, so whoever expected that? Broader market participation has helped portfolios that are diversified, such as ours. So we've seen commodities and international things like that really help. The extension to the Tax Cut and Jobs Act has provided support to potential consumer spending, but there's also concern that there will be a fiscal drag from, you can't forever lower taxes and increase spending. So that's going to be something that still has to be dealt with either now or in a future administration. We don't know exactly how that's going to happen, but the breadth is encouraging to us. The AI, artificial intelligence, that continues to drive innovation, and we believe will continue to drive innovation and potential long-term economic benefits, not just the companies that are producing the chips and the software, but we also see opportunity in the companies that are supplying what those companies need to perform. Power grid, other infrastructure like building data centers and such. We don't think the AI trend is excuse me, is bound by regional constraints, but a lot of the AI world is in the US, and so a lot of that is going to be happening here. Earnings are something that have been good. But if you look at, so 2026 earnings are being used now to value the S&P 500. I think Debbie yesterday talked about it being about $300 a share is the estimate, which means that the current level of the S&P 500 is about 21 or so times the earnings for 2026. Those earnings support the valuations. It's a little rich right now. The market's expensive, though. I'm kind of slipping into the risk section here. The market's expensive based on 2025 earnings, and even getting a little rich in terms of 2026 earnings now. So in the risks, the biggest one I think we probably have is that the prices are high going into the second half. And if we get some bad news, like a whiff of return of inflation, or another tariff announcement that the market takes seriously, that could be something that causes a quick and sudden drop. As I mentioned, there are better than 50% expectations of the rate cuts to begin in September, but we know the US Fed, Jerome Powell's watching the data, and he mentioned that he would already be cutting rates if it weren't for the tariffs. So if data coming from earnings and inflation tells the Fed to pause, then that could be a downer on just overall market sentiment. I do want to say as an aside, though, that with the rates where they are right now, you can still make more than 4% on cash. We have a position traded money fund that we put people in all the time that's paying around that. So if you have a bunch of money in the bank and you want to talk to your advisor about that, that is an opportunity while the rates stay where they are. But nevertheless, the tariffs are still higher than they were when we were talking to you last year. And so if they stay higher for a long enough period of time, that could continue to drag on earnings and possibly lead to inflationary responses by the companies that are having to pay the tariffs. We think that having value, there could be value in foreign assets and commodities continuing forward if the dollar weakens. But bad news on the geopolitical front or a bad earnings report could lead to a quick sell-off. And then finally, I wanted to say on the new tax legislation, we will be talking to you more about that later. There's a lot to digest. So we're not mentioning it on this call just because there's a lot to go over with the new tax bill. So to summing it up, right now, July 24th, we are watching the market, quote unquote, melt upward in the face of things we know are bad out there because it just hasn't gotten bad enough for the market to sell off. We are taking a wait and see approach to where things move, but also looking to make short-term moves in the interim, like we just started adding an infrastructure fund based on our view of the continued growth of artificial intelligence. And we are going to continue relative strength plays that we could be doing while we watch how the different parts of the market are performing. And with that, I think I probably talked a little more than I meant to. I want to turn it over to Debbie, who can show you the charts and really show you where we get what we think.
Thank you, Peter. All right, starting here with chart number one, the point that I want to make here is that everything Peter has talked about, the inner workings of the market, it's all true. It's what makes the charts work. But the charts, in the final analysis, I think, are like a roadmap, helping us to decide what can we expect moving forward. So, asset market, one of the important thing to know is that asset markets are driven by two moving parts. One, liquidity inflows, which are largely driven by central bank money creation and government spending. And two, the allocation of those flows, which is largely driven by investor risk appetites. Currently, liquidity conditions are supportive of asset markets, as we can see in this chart that's on the screen, which shows the S&P 500 index, the orange line, and the National Financial Conditions Index published by the Chicago Fed, the blue line. As you can see, they are almost perfect mirror images of each other. In other words, when liquidity is abundant, the market tends to go up. When liquidity is tight, the market tends to go down. Liquidity tightened briefly during the tariff tantrum, but has since eased back to levels before the crisis. In a similar fashion, the market sold off sharply in April, but has since recovered. Risk appetites, the second mover of the market that we're going to see in the next chart, have rebounded as well. A simple model to illustrate the impact of risk appetites on fund flows is the relative performance of stocks versus bonds. If we can move on, there we are. Okay, in good times, so what we're seeing here on this screen is the relative performance of stocks versus bonds. In good times, money flows out of bonds and into stocks. In bad times, it flows out of stocks and into bonds. As we can see in this chart, the April tariff tantrum temporarily pulled down investor risk appetites. But as the economy and markets recovered, risk appetites rose along with them. And as you can see at the right edge of the screen there, are making new highs. Stocks versus bonds are making new highs. So putting the two together, the S&P 500 is once again trading well above its historical price to earnings ratio, which you can see in the next chart. Despite the uncertainty over the effect tariffs may have on economic growth later in the year, what we can see here is that the turquoise line on this chart represents the S&P 500. The darker line is actually the earnings per share of the S&P 500 over the last basically 10 years. When the turquoise line gets above the earnings line, when the price of the S&P index gets significantly above the earnings line, that typically is what we consider to be an overvalued market. When the turquoise line goes below the darker line, that is what we consider to be a more undervalued market. So as you can see, after that brief period in basically back in 2022, when the market had a significant drawdown, we have more than recovered that and are, as Adam mentioned earlier, trading at new highs. The big question for investors is what will happen to growth this year. If it continues to rise, flows into global equities will likely remain strong, and stocks can move higher. If growth stalls, however, or worse, declines, those flows could quickly reverse as risk appetites fall and investors cut their exposure to risky assets like stocks. To help me monitor investor growth expectations and risk appetites, I have developed a risk-on, risk-off indicator that compares the performance of risk-on cyclical markets and sectors to risk-off defensive ones. This indicator turned negative in February and March of this year, warning of trouble ahead. It turned positive in May and has been rising ever since. The market has moved up a lot since the low on April 9th and could experience a pullback at any time. But with ample liquidity and healthy risk appetites, any declines will likely be temporary and could represent good buying opportunities.
Thank you, Debbie. That was excellent. And one of the things that I just want to sort of recap between Peter and Debbie's presentation are a couple points. Number one is we have a process around this to help our clients navigate choppy environments, and we're not just taking throw at the wall and see what sticks kind of approach. The second thing I would like to highlight is just the fact that these are all pieces of the puzzle that you're starting to see. One of the things that's unique about the chart that's still up there right now is the S&P 500 is what's called a cap-weighted benchmark, which means that the larger the companies in the benchmark, the more influence they have on the performance of the benchmark. And what we're seeing right now is your largest companies are AI tech-driven companies. So it's not really a surprise to see that the S&P 500 is trading above the broad earnings of the entire S&P 500. But it is something to just be aware of, that yes, the market is a little trending above historical averages and is at a high point. So to dig a little deeper, I do want to shift and turn it over to Brandon Perlow, one of our certified financial planners, as I mentioned earlier. And really what he's going to be talking about is the genesis that a lot of clients have increasingly asked us how they can invest in line with their values. And so there's been a trend towards ESG investing, and Brandon has taken it on as a challenge to develop the portfolios and the investments within those portfolios to help our clients fulfill that objective. Brandon?
Thank you, Adam. Good afternoon, everybody. The first thing I would say, we know this is not for everybody, and our ESG screens are not screens that we're running for all of the other models that we run. But I will say they have been growing here at Able. We have more clients who are asking for this, and so we wanted to share a quick update on where things stand, what has happened so far this year, and what we think may happen going forward. Overall, we have 58 unique models that Peter and our investment team are managing. 4 of those are ESG specific models, and we noticed through May that all 4 of the ESG models are ranking in the top quartile, and 3 of the 4 are kind of best in class for their given equity levels. So wanted to see, why is that, why might that be, and then what can we dive into. We know the current environment is not particularly ESG friendly, and so we get a lot of questions. How is that going to impact these returns? And we're not seeing that play out at this point in time. We also know ESG funds broadly are seeing net outflows. Generally speaking, that's not great for funds to see outflows. So how does this impact performance? And so those are the questions we're going to try to answer in a few minutes here. On the next slide, you'll see there are 3 different levels of ESG funds that are available to us, and we are using the ESG aware approach in the middle. And what this is, so we're looking for environmental, social, governance, funds, but we're doing it with the same or similar risk profile to the broad market. So ESG is a secondary consideration to similar risk-adjusted returns. The ESG Advanced on the right, that is where ESG is the #1 priority, even at the expense of risk-adjusted returns. We're not going out that far on the spectrum, and those are the funds that have, been impacted because of the current, political and investor climate. So part of why our models are doing well and holding up is because we've taken this ESG aware kind of middle of the road approach. On the next slide, this also will help answer the question. You can see, so on the left are the top 10 holdings for the biggest fund that we're using in our ESG models. On the right is the top 10 for the S&P 500. And you can see 8 of the 10 names are the same. Now, where they rank changes a little bit depending on, exactly what ESG metrics they're performing. There are a couple names that drop off on either side for a variety of reasons. Some of those are not excluded entirely, but they're further on. They're just not in the top 10. But again, to answer the question, well, we are still largely owning the broad market, just in a slightly different factor than if we just bought the S&P as it stands. So that's a fair part of it. And then on the next slide, you can see there's an academic answer to this too. So I had the opportunity to meet Dr. Pruitt last year at ASU. He was one of 3 authors, and I have this, by the way. So if anybody is really interested in the academics and wants to read the long form version, I'm happy to share it. But the quick summary is basically they determined that you can promote, have ESG funds in your portfolio without sacrificing returns. So you can do this on a risk-adjusted basis, which means that overall, there's not a cost for investing in ESG. So to Adam's point, if this is something that is in line with your values, this is an option that we have, and we want to make sure you know that. In terms of the letters themselves, the kind of bottom right here, we do know that there's this prominent E factor. So what that means is the environmental aspects, that has been proven out. So you can take a portfolio and increase its environmental friendliness without sacrificing returns. We don't have the evidence for that in the S and G categories, so the social or governance. So if you go to the next slide, I'll come back to the environmental, but this is just showing what are we looking at. We start with the entire market, and we avoid companies that have, pretty big ESG issues. And then we also have a profitability screen. So we're looking for companies that are profitable and expect profitability to increase, and that creates the ETFs that we're using in our ESG models. The last slide here, it's just going to show. So if we know that the environmental aspects, hold up, and we can still maintain our maximum risk adjusted returns, well, how do we do that? And the answer is we reduce the carbon emissions. So what this is showing is, compared to, the equity markets at large, the funds that we're using are emitting 68% less carbon dioxide and 99% less oil and gas revenue to maintain risk adjusted returns. So we see it on the academic side. We've kind of seen the proof of this on the investment side. And again, just want to share, this is an option, by no means whatsoever mandatory. If it is something that interests you, please talk to your advisor, talk to me. I'm here, happy to answer questions, happy to help.
Awesome. Thanks, Brandon. Nice presentation. I'm going to now turn it over to Matt Cherry, certified financial planner, advisor here. And he's going to talk a little bit about using alternatives in invest portfolios. And he'll dive into where they fit in and a particular strategy that may fit in to clients' investment strategies as well, given the high level of valuations, as I mentioned earlier. So, Matt, take it away.
All right. Thank you, Adam, and hello, everyone. Now, it's probable that you've heard the term alternative investments, and it's possible that you've wondered what the heck they are. So if that's you, I get it. You're not alone. The truth is, alts are just anything besides usual stocks and bonds. Think of your portfolio like a toolbox. Stocks and bonds are the trusty hammer and the screwdriver. They're great basics. Alts are the specialty wrenches, the power drills, the private equity, real estate, commodities, hedge funds, precious metals, and structured products. Each one tackles a different job, from adding new return streams to buffering when markets get bumpy. So they're used everywhere. Top university endowments park over half of their money in alts for smoother long-term growth. We sprinkle them into almost every client account for the same reason. On the next slide, well, you've probably heard us mention structured notes. So picture these as a hybrid bunk bed. Bottom bunk is a bond giving you downside protection, and the top bunk is an option offering the potential for upside market returns. Now, I'm not going to get into the nuts and bolts of it with these, but we work directly with the banks to create these on disciplined strategy that we built. We think of these as a way to mitigate risk for a portion of your portfolio. They're not one-size-fits-all solution, but for the right investor, they could be a good fit. So the bottom line is, with alternative investments, there's no mystery, just proven tools that savvy investors rely on. And with markets near all-time highs, as we've been talking about through this entire webinar, volatility is lurking. Adding the right alts can help smooth the ride. If you're curious how these fit in your portfolio, give us a call. Happy to go through those nuts and bolts with you. And with that, I'll hand it back to Adam.
Excellent. Thank you. Again, if you have questions on any of the items we've discussed so far, please feel free to use the chat feature or the Q&A feature here on Teams, and or feel free to email any one of us directly, and we'd be happy to assist. Before we take any questions, I do want to take just a moment to highlight some of the differentiators here at Able Financial Group. First and foremost, as you can tell, we take a team approach to helping our clients solve their financial questions. We have a team of specialists that work collaboratively for the benefit of our clients. And we have an unbelievable team here. I'm so proud of the work that they do every single day for our clients. Our advisors, year to date, have made 2,459 proactive calls to clients through last week. They have sat in 498 meetings so far this year. That's unheard of. Teams don't do that. Okay. Our team focuses on stewardship, not salesmanship. We believe that by taking care of our clients, the rest takes care of itself. And again, that's phenomenal effort to be in front of our clients, particularly when markets are fluctuating as they have been. We manage the investments in-house. Many teams are outsourcing their investment management to third parties called TAMPs or separately managed accounts, or they're using their firm's shelf-provided solutions. For better or for worse, we own it. We have an amazing team spearheaded by Peter. Debbie's assisting very closely, and all of the advisors are working closely to help think and strategize how we can help our clients navigate volatile times. And then we live by a standard of core values. And it's really unbelievable to see how it's demonstrated every single day. We have 4 core values that we operate by. Number 1 is to maintain non-negotiable integrity. We don't compromise on doing the right thing for our clients. We act as fiduciaries. We have a genuine interest in our clients. We love our clients. They become friends, they become family. And we like to say that no one cares more about their money besides them than us. We want to help them live the best life they can. We make and keep meaningful commitments. We work extremely hard, and I have an unbelievable administrative team that has the unenviable task of delivering on all the promises that we make, but they work their tail off to do so. And then we have a continued effort and commitment to doing things better. We're never complacent. We are always finding ways to improve. We welcome your feedback around that, and it's something that we take with humility and constructiveness. So look, we work hard for our clients, and we're committed to making that work. So if you or your friends or your family are not getting the attention they deserve, or they're not getting the depth of expertise, or they simply just want a second opinion, I hope you know where to direct them. It would be a privilege and an honor to assist any